Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:02 a.m. Pacific on June 27th, week before the 4th of July, and a lot's happened. Let's just jump right into the bloodless verdict of the market. Pretty interesting. The S&P 500 has broken through its all-time high, currently trading at 6181, up 3.5% on the week, which puts it up over 10.5% on the quarter and over 4.5% on the month. So big wins in the S&P and in stocks in general. Looking at the technology sector, quarter to date, it's up 22%, month to date, up 9%, week to date, up 5%, the best performing sector. So the AI animal spirits are alive and well, and the stock bulls are alive and well. If we kind of look through there, if you're looking for where the laggard is, energy down 3.5%, and on a month-to-date basis, still up 5%, but down 8% on the quarter. And that makes sense considering the huge geopolitical news of the week, which was the ceasefire brokered between Iran and Israel that seems to have held, and the commensurate decline in energy risk premia and drop in oil prices. So that plus news of new trade deals coming through has kind of put the markets into a sanguine attitude, and that's where we are. Kind of, if we want to maybe look at growth stocks, for example, up 4.5% on the week and up 17% on the quarter and almost 6% on the month. Value stocks, on the other hand, up 2.5% on the week, 3% on the month, and over only 3.5% on the quarter. So, I mean, look at that disparity. Up 17% in growth stocks quarter to date, up 3.5% value stocks quarter to date. I mean, that's the tail of the market right now, in my
One day
opinion.
growth will be overtaken. It seems like value. Everyone's off and on. You've had people making the claim that value. Its time will come, but growth continues just to be the horse at the head of the race.
Definitely the horse in front right now, and that's kind of the stock market for you. If we kind of go over to the bond market, it's been a positive week in fixed income land with the aggregate index up about 1%. The best performing sectors were mortgage-backed securities, investment-grade corporate bonds, and emerging market bonds, all up slightly over 1% on the week. Looking at it on a quarterly basis, you've eked out a return in bonds as well, with every sector positive. The ag's also up a little over 1%. So definitely a positive situation for asset holders this week, this month, and this quarter. Looking at the month-to-date returns on the ag, up 1.4%, with the best performing sector, emerging market bonds, up 2.1%. So positives across the board there in stocks and bonds this quarter, this week, this month. So asset holders pretty happy, not much to complain about. Considering all the volatility we've experienced, maybe you're not being compensated for the stress and anxiety, but you're definitely being financially compensated for putting your money to work. Moving over to commodity land, things aren't as rosy. Looking on a week-to-date basis, down about 3.7%, led by the energy sector, down over 9.5% on the week. And that's kind of reflected in the quarterly information too. The broad commodity market is down 2.5% quarter to date, with the energy sector down over 9% as well.
So the hits keep coming with energy too. I saw a headline this morning. I was talking about a further expansion of production by OPEC, further output
Yeah,
increase.
there's definitely pressure to keep the energy ecosystem well supplied with crude oil, and you've seen that in news announcements like the one you just mentioned. WTI crude, for example, down 11.5% week to date, currently trading around $65 a barrel. Month to date, though, it's still positive, but quarter to date, down 5.5%. Everybody wants to talk about the kind of flight to safety assets these days, so let's check out gold and Bitcoin. Well, gold down about 3% on the week, down about 0.5% on the month, but this quarter, in the second quarter, it's up 4.5%, currently trading at $3,288 a troy ounce. Bitcoin trading at 107,471, up 3.6% on the week, and up a whopping 30% on the quarter. So that's pretty strong. The monthly return is up two and three quarters. So you got black across the board in Bitcoin. And last but not least, we'll kind of let's look at two more things that could be interesting for our listeners. Copper, Dr. Copper, the economic bellwether, up 5% on the week, up 8%, over 8% month to date, and up about 0.5% quarter to date. So positivity coming from that indicator. And then lastly, the dollar has suffered. The dollar has dropped about 7% quarter to date, down 1.5% week to date, and 2% month to date. So, I mean, kind of just broad synopsis of the market. It's been positive for stock and bond holders, kind of a rough ride for commodity holders, but definitely the bulls are in charge. And that kind of wraps it up.
Yeah, thank you for covering that there. Hey, one last thing actually just catching my eye here, and it's after this week that you're talking about copper and gold. It's interesting that copper is now ahead of gold year to date. That maybe would be aligned with us hitting year to date highs or new all-time highs in the stock market, but
yeah, I mean, it is an interesting point you bring up. Copper's up about 26% year to date. Gold's up about 24%. I'm going to say that that's going to be a photo finish, though. That's not like a resounding victory there, but it is an interesting point. With that, let's jump into the macro.
yeah, let's do it. Nothing much in the macro was too market moving this week, other than, well, you know what? Let's just run through them one by one here. Starting on Monday, June 23rd, we had the S&P Global US PMI data for the month of June. This is prelim data. The manufacturing printed at 52.0. That was 1 point above estimates, right in line with the prior. While the services printed at 53.1, slightly ahead of the estimates and 0.6 below the prior. All in all, this just S&P Global continues to show that we're in this, decent expansions streak. The manufacturing has been on a 6-month streak of prints above 50. The services have been on a 29-month streak. There's a couple extra points of this I want to dig into just for a minute or so. A few different kind of call them just topics within this report underneath the hood. There was the topic of stockpiling, and this is stockpiling of inventory of goods. It was noted that manufacturers really picked up their purchases of inputs as well as built their inventories of inputs. So they were buying them faster than they could produce them. It also showed that the inventories of finished goods at factories showed their largest rise in 9 months. So in general, this is trade, related, but it's just showing us a stockpiling generally of goods, more so in the manufacturing space. Another aspect of this report was rising prices. Not surprisingly, on the manufacturing side, it showed both output and input prices expanding at the broadest rate that it has since July of 2022. So there is some expectation for that to pick up for manufacturers. On the services side, you're still having expanding prices in this report, but it did soften a bit from the May month. Surprisingly, in this, we had expanding employment. Companies expanded employment at a 12-month high rate for manufacturing and a 5-month high for services. I want to give a bit of a kind of a potential for reversal here and kind of just cage this that stat a little bit. June saw the largest accumulation of uncompleted work in 3 years. And so with manufacturing backlogs rising for the first time in 3 years, there's, a bit of a pickup in hiring to try and deal with that backlog. If this is just them stockpiling finished goods and those don't sell through, you could see a bit of a reversal. So we'll see how actual consumption of those goods goes. And lastly, sentiment. We're off the little local low that we saw in April, but still weaker than we started the year. Manufacturer sentiment may be doing a little bit better on a relative basis than services lately. It's just kind of picking up with hoping that the trade protection is supposed to help them out. But that kind of wraps up that report there. Moving forward to Tuesday, we got S&P Core Logic, the 20-city month-over-month report. This is the home price appreciation for the month of April. It printed at negative 31 bips on the month versus estimates of just basically flat. It was 16 bips below the prior print. This is back-to-back months of contraction or, of contraction in home prices. First time we've seen that since there's an 8-month streak back in Feb of 2023. This all rolls together, brings the year-over-year number down to 3.42 versus a prior of 4.08. That's the lowest we've seen since August of 2023. Look, it was good run up. We'll see how long this little period of softening lasts. I will say that, look, these were seasonally adjusted numbers. On a non-seasonally adjusted basis, like March was up 1.12%, April was up 75 bips, but that's not how we look at these numbers on a month-to-month basis. So, softening home price appreciation there, or home price depreciation.
Can't say that that's a big surprise given the
No,
overhang of high rates and high prices. That said, a rising stock market, maybe it's going to cajole some people to take money and plunk down for a house, but we'll have to wait and see.
yeah, I hear that. We were talking a little bit about that this week. So Tuesday, we conference board consumer confidence for the month of June. Not going to dwell on this too much. We had a bit of a pullback, printed 93 versus estimates of 99.8. Most of this was carried by the present situation degrading. I'm going to say that, look, we had a large bounce off of the April lows in May. This is a bit of a give back in June. I think it's as simple as that. If you look at the expectations metrics within this report, all of them look better than April. And the present situation, some are better than April, some are worse than April. But in general, I think this is just a bit of a give back, and I don't want to dwell too much on this survey. Moving forward all the way to Thursday, we got the third estimate of Q1 GDP. This printed a bit below expectations at negative 0.5%. That was 30 bips below the estimates and the prior.
You got to throw this information out, in my opinion. Even the Fed economists with their 300 PhDs don't trust this info, and you're going to really have to lump the first quarter and second quarter together because all of the wonky trade flow information is distorting the reading. So it's just not really meaningful, in my opinion, to analyze Q1 GDP in a vacuum. You got to look at combined with Q2 to get a sense, in my opinion. So it'll be a couple months before we really know, how the economy did in the first half.
I'm fully agreed with you. Actually, I brought it just this print and what we've been talking about when it comes to GDP brought back an old Janet Yellen quote of when she said GDP is a pretty noisy indicator. Right now, that's how this looks. I mean, we had a bit of a pullback in personal consumption on the revision, but I'm not going to dwell on this number too much. As I agree with everything you just said right there. So we'll see how Q2 comes in. It's expected to come in hot, and we'll blend this all together and kind of marry it together and see where the chips settle. So that brings us further on Thursday. We get durable goods orders. The head for the month of May. This is prelim data. Headline prints. It's a very volatile number. Like it came in at 16.4%, very high ahead of estimates and the prior. This is due to a 231% increase in non-defense aircraft orders. After that, just spew of numbers. Let me try and summarize the rest of this report a little clearer. The durables X transportation. So now get rid of the volatile transportation figures. That was up 50 bips on the month versus estimates of flat and a prior of flat. This is the strongest print we've seen since September of last year. But I'm going to say that while we're up 50 bips on the month, we're only up 40 bips year over year. So you can say that on trend, this has not been doing great. But we'll see how those numbers continue to develop. I think more exciting in this is the cap goods orders, non-defense X aircraft, and the shipments, non-defense X aircraft. The orders printed at 1.7%. That was 1.6% above estimates and 3.1% above the prior. While the shipments, this is the number that hits the GDP calculation, that hit 0.5%. That was 0.6% above estimates and 0.5% above the prior. Again, just like the durables X transportation, want to couch this a bit in the year-over-year figures. Your orders were up 1.7% on the month, yet you're only up 2.3% on the year. Your shipments are up 50 bips on the month. You're only up 1.3% on the year. So, year to date, things are looking pretty good, but if not for these outsized prints this month, we'd say things are looking pretty bleak. So I'm just going to say this is volatile data, and it continues to be volatile, and we'll see how it goes through this whole, trade debacle. Also on Thursday, we got initial jobless claims for the week ending June 21st. A little reprieve here for initial claims. This printed at 236,000. That was 7K below estimates, 10K below the prior, and that allowed the 4-week moving average to inch down by 1,000. So, like that 4-week moving average is still below where we had a kind of a local peak back in June of 2023, but we are higher than we were in the kind of scare in August of 2024. And when we got continuing claims for the the week ending June 14th, that printed at 1.974 million, 24K above estimates, 37K above the prior. This continues to trend up. The 4-week moving average has risen by 69K in the last 6 weeks. I'm going to say that as this continues to grow, it seems like the odds of rate cuts are also growing. We'll talk about WIRP a little later, but look, I only about I like to remind people only about a quarter of the unemployed are actually on continuing claims. So, like we had a 37K rise this month. That's ballpark, back of the envelope math, about 150,000 increase in the unemployed. So I wouldn't be surprised if we have a bit of a tick up in the unemployment rate this month, which we'll get to in a minute. Moving forward, we have today's data. We had personal income and spending for the month of May. This disappointed. Definitely worth some details, but let me run through the numbers real quick. Personal income printed at negative 0.4%. That's 0.7% below estimates and 1.1% below the prior. So very weak relative to expectations. And personal spending came in at negative 0.1%. That was 0.2% below the estimates and 0.3% below the prior. So, look, I need to give a couple stats here. I will say for the income, this is the first negative print we've seen since September of 2021. We saw negative spending earlier this year in January, so I'm not going to dwell too much on the spending. It's a weak print. It is what it is. It's not good, but we'll see how it continues to develop. But the personal income, this one, I want to say that it's not as bad as it sounds. I'm a little surprised the estimates were so low. Let me give you just a couple figures here. I'd say the biggest explanation for this, at least in terms of the negative print, not relative estimates, but the absolute negative print, comes from transfer receipts. We've talked about this in prior months. There was the Social Security Fairness Act that was signed into law on Jan 5th this year. This boosted payments for certain government workers. And as a result, over the last 6 months, the average contribution to personal income has been about 15 bips from transfer receipts. This month, it seems like those additions have run their course, and we were down 43 bips on a contribution basis. We're down 2.23% this month. So, I mean, the difference there between the run rate and what we printed is about 60 bips. That's almost your entire miss right there. But can add to that, business owners' income makes up about 10% of the basket. That was down 2.3% this month. It had a strong couple of months, the last two, and it looks like a bit of a give back. So there was about a 20 bip give back from that relative to its 6-month run rate. So right there's 80 bips. If you're looking at compensation, that's the main driver that makes up almost 2/3 of personal income. It was up 40 bips on the month. It contributed 24 bips to the headline print versus a 6-month trailing average of 26 bips. I'm going to say that's pretty steady. So, a year to date personal income through April was up at 8.2% on an annualized rate. So a little give back this month doesn't seem too unreasonable.
I think that's interesting stuff, but it's noisy, like you said.
I agree.
And I think the biggest thing that happened today was the PCE. Let's talk about that.
Oh, well, before I get that, I just want to just list off the personal spending is just a decline in good spending. It was down negative 76 bips in the month. But PCE, look, they're not much to say there. Look, a small beat. I'm going to say that it's rounding. These numbers are generally accurate. The headline prints came in line with estimates. The headline month over month printed at 0.1%. It's right in line with the estimates in the prior. The year over year for month of May printed at 2.3%. It's right in line with estimates and a tick up of 0.1% from the prior. That's just roll off. This is a weak roll off month. It's actually the weakest roll off month we have in the year over year core calculation. The core core PCE for the month was up 0.2% on the month. That was 0.1% above estimates, 0.1% above the prior. This led into the year over year number inching up to 2.7%. That was a 0.1% increase. Look, I mean, the print on a unrounded basis was 0.18 for core, and the roll off was 0.08. So there's your 0.1% increase in your year over year figure. We'll say the last 3 months of core PCE annualized to 1.65%. So not too bad as of late. Decent inflation data we've been seeing, which that'll feed into what we're seeing in terms of rate cut expectations.
Yeah, definitely. Definitely good kind of run through, Kimbrough. I agree with you that inflationary data is in the direction the Fed wants to see it. And you saw that with the expectation of a cut for September pretty much laser beamed in the market right now. Now we'll see what happens. Furthermore, you also have the talk of the shadow Fed, which we've been speaking about for a few months, but the shadow Fed governor being kind of brought forth in the fall to kind of even maybe cajole the markets a little expectations of rate cuts
We'll hear more and
higher.
more about that little by little.
Yeah, so just keep an eye on that. That's something to keep an eye on, but we'll keep you apprised. And there's now 4 candidates in the race to be the Fed governor, but I think it's a bit too early to really dissect that, but just keep that in mind that, if there is a more talk of the next Fed chairman in the fall. That's going to change the rate expectations pretty significantly. And that's all we got from Federal Reserve Watch and Rate Watch right now. What about next week? I mean, it looks like a pretty light week. I mean, just high level, we got ISM manufacturing coming out on Tuesday. Estimate's supposed to be 48.8. The prior was 48.5, so pretty close there. We got the JOLTS job openings coming out, which is estimated to be 7,320,000, lower than the prior, but we'll have to see if that labor market's tightening up. We also got the Challenger job cuts and the ADP unemployment change because it's going to be payroll Thursday because of the 4th of July holiday.
Mm-hmm.
That ADP stuff, I don't really look too much into it. Do you have an opinion on it, Kimbrough?
I say we move on.
Yeah, I agree. So it's going to be a jobs Thursday next week, and I'd like to remind our listeners we're going to be skipping the podcast next week. So we hope you all enjoy your holiday, and we won't be recording next week, but we'll be recording 2 weeks from now on Friday, July 11th. So I hope you enjoy that holiday. But that said, we do get the jobs Thursday data on July the 3rd. And the change in non-farm payrolls is predicted to be 113K, down from the prior, and the unemployment rate is predicted to tick up to 4.3%. And it was close to the round on the prior, so I wouldn't be surprised if that happens. I mean, I think that that's pretty much a lock, but we'll have to see how things shake out. And we also get ISM services, which is predicted to come out at 50.5. Where the prior was 49.9. And that wraps up the week ahead, unless you have anything to add, Kimbrough.
No, I said that's you know what? I actually do want to bring up one more thing. I WERP is now at 2.6 cuts. I just refreshed that and it just shocks me to see how much it's shifted. But
Yeah, definitely the shadow Fed stuff is starting to creep into the market's expectations, but I don't know what will actually happen. But
yeah,
definitely
that's
something to keep in mind. And that wraps it up for the week.
yep. Thanks to our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yep. You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doubleline capital and check out the interviews of Bill Campbell and Jeff Sherman on there. Some good new content for you to check out.
Yeah. Thanks everyone out there and enjoy the 4th of July. Be safe.
Yep. Thank you and enjoy the 4th of July.